welcome back to the MCF Education Series. My name is Hunter Nighbert, and I'm a financial advisor and retirement planning specialist with MCF Advisors. Today, we're going to talk about navigating and coping with market volatility. In life and in investing, it's all about what you focus on can make all the difference. Take a professional baseball player, for example. Standing at the plate, the batter has about 0.45 seconds to react to a 90-mile-an-hour fastball. In less than a half a second, the batter must determine what type of pitch is being thrown, how fast it's coming, and whether or not they should swing. And all the while, a crowd of 30,000 people or more are yelling and dancing to music with giant video boards around and the smell of hot dogs and nachos and beer all over the park. How do players perform with so many things to think about and so many distractions at hand? The answer is through selective focus. A successful hitter learns how to tune out the fan noise, the stadium commotion, and all the distractions in the dugout and focus on the one thing that matters, the pitch. He understands that his only objective at the moment is to hit the ball, so they tune out all of those distractions and noise and just see the pitch. Investing in your future is similar in many ways. As if the distractions of life aren't enough, we are constantly bombarded with external noise from news stations and publications and social media, especially when markets decline. And if by chance you don't get sucked in by all of those factors, there's always friends and family and coworkers that add to this by externalizing their own stress and anxieties, which ultimately just get added to our own full plates. Just like the baseball analogy, focusing on the long-term objective can help you too. As you continue this savings journey, you will see many different market cycles. When significant down markets occur, your emotional anxiety will naturally rise, and you will hear and absorb more noise that could influence your investor behavior and decision-making. To help broaden your perspective, let's look at how long-term focus can make a difference. This is a chart that shows the rolling averages since 1950 for stocks. Stocks are in green, bonds are in blue, and there's also a 50-50 mixed portfolio of stocks and bonds in gray. And it's the dispersions of all these returns. The cluster to the left shows one-year returns in the stocks range from a positive 47 to a negative 39%. That means in any given year, it ranged from 47% to down 39%, just to be clear. Bonds range from 43% to a negative 13%, and the 50-50 portfolio ranged from up 33% to negative 15%. The returns in any one-year time period are all over the place, both positive, negative, and everywhere in between. As the time frame increases from 1 year up to the 20-year rolling averages, the losses become much, much lower, and the farther we go out, the 20-year rolling average is all positive numbers. This means in the time frame that you can pick any date and go 20 years and the returns are positive. Still not convinced that making moves in a down markets is a bad idea? Take a look at this chart. If you'd invested $10,000 on January 1st, 2003 and left it fully invested, you would have a balance of $64,844 or an annualized return of 9.8% over this 20-year time period. However, if you missed the 10 best days out of 20 years, you would have made a 5.6% return. If you had missed the 40 best days out of the 20 years, you would have lost money on your initial investment. Now, to be clear, that is 40 days out of over 5,000 trading days that the market has had in that time period. It's also important to note that 7 of the best 10 days occurred within 2 weeks of the 10 worst. 6 of the 7 best days occurred after the worst days. It is also just as important to not delay the start of your savings journey. The longer you wait, the more money out of your pocket it will require to develop an adequate savings, and thus creating further stress on you. In this example, Alex starts saving at age 20 and saves $2,400 a year for 15 years. At the end of age 67, Alex will have nearly $470,000. In the same 6% return ratio, Donnie starts saving for retirement at age 30 and then saves the same $2,400 per year until he is 67. He has more than double out of pocket and much less for retirement at 67 with only $240,000. We can get back a lot of things in this life, but time is not one of them. So make sure you start your savings journey early. Lastly, proper diversification of your portfolio can be very powerful to lower your volatility during turbulent times. Most people think that diversification is simply not putting all of your eggs in one basket, which is partially true. But the fact is, how much you put in each specific basket is what matters. True investment diversification is intentional exposure to each asset class because each asset class has unique characteristics that limit any one market cycle or market risk, and they do this in slightly different ways. Diversification has helped investors reduce volatility and in some cases can potentially increase returns. This chart illustrates the risk and return relationship of 5 diversified portfolios. Returns are measured on the left, top to bottom, and the higher on the chart, the better the return. Volatility is measured from left to right on the bottom axis, and the farther to the right means the more susceptible to the market's ups and downs the portfolio is. The portfolios closest to the bottom have the lowest returns. In other words, the portfolio with 100% invested in bonds had the lowest return of 8.44%. The portfolio with 20% in stocks and 80% in bonds had a higher return of 9.09. By adding 20% stocks to the bond portfolio, it increased the return and actually decreased volatility. Now let's compare the portfolio with the 50% in stocks and 50% in bonds to the one with 100% in bonds.